Wouldn't it be great to manage your portfolio on one platform? Well, now you can trade all in one place on Robinhood. That means you can trade individual stocks and ETFs and also buy and sell crypto using seriously powerful and intuitive tools at one of the lowest costs on average without needing to manage multiple apps. Robinhood makes withdrawing and depositing crypto seamless. Send crypto to your Robinhood account or send crypto from your Robinhood account to other wallets without deposit or withdrawal fees from Robinhood. Trade all in one place. Get started now on Robinhood. Trading crypto involves significant risk. Crypto trading is offered through an account with Robinhood Crypto LLC. Robinhood Crypto is licensed to engage in virtual currency business activity by the New York State Department of Financial Services. Crypto held through Robinhood Crypto is not FDIC insured or SIPC protected. Network fees may apply to crypto transfers. Crypto transfers may not be available to all customers. Investing involves risk, including loss of principal. Securities trading is offered through an account with Robinhood Financial LLC, member SIPC, a registered broker-dealer.
Welcome to Learn Finance 101, where we break down essential financial insights to help you make informed decisions. In this episode, we're going to explore a really important concept in ESG investing, portfolio exclusions. You might have heard about ESG, which stands for environmental, social, and governance. It's all about aligning investments with ethical values and making sure you're supporting companies that are doing the right things in terms of sustainability, social impact, and corporate governance. But what happens when certain companies don't meet those standards? Well, that's where portfolio exclusions come into play. So, what exactly are portfolio exclusions? In simple terms, they refer to the practice of intentionally excluding certain companies or sectors from an investment portfolio because they don't meet specific ESG criteria. The goal here is to avoid investing in industries or businesses that have a negative impact on society or the environment. Let's start by talking about the environmental side of things. This is a big one. Many investors today are deeply concerned about issues like climate change, deforestation, and pollution. So, in an ESG framework, investors might exclude companies involved in activities that harm the planet. Think about companies in the fossil fuel industry, like coal or oil producers. These businesses are major contributors to carbon emissions. For someone focused on reducing their environmental footprint, excluding these companies is a way to avoid supporting industries that drive global warming. Other examples might include mining companies or businesses that are known for causing deforestation. Then we've got social exclusions, which focus on the impact that companies have on society. Here, we're talking about industries or companies that might be involved in things like poor labor practices or controversial products. For instance, many investors choose to exclude tobacco companies from their portfolios due to the harmful effects of smoking on public health. Others might avoid companies that manufacture weapons, particularly those involved in producing controversial arms like nuclear weapons or landmines. And of course, there are industries like gambling or alcohol that some people choose to avoid on ethical grounds. Another key area is human rights. Investors may exclude companies that have been involved in things like child labor or unsafe working conditions. It's all about ensuring that your money isn't supporting businesses that go against your social values. And finally, let's talk about governance exclusions. This part focuses on how companies are run. Investors concerned with governance might exclude companies that have a history of poor corporate governance, such as those involved in fraud, corruption, or a lack of transparency. Imagine a company whose leadership is constantly embroiled in scandals, or one that doesn't allow proper oversight of executive compensation. That's the kind of thing you might avoid if governance is a priority for you. Good governance is really about ethical leadership, accountability, and making sure companies are run in a way that benefits shareholders and stakeholders alike. Now, if we zoom out a bit, these exclusions are often part of a broader negative screening strategy. This is one of the ways investors can take an active role in shaping their portfolio to reflect their values. Instead of focusing just on returns, they're saying, I don't want my money to support industries or companies that do harm. That could be for environmental reasons, like avoiding companies that are responsible for massive pollution, or for social reasons, like steering clear of businesses with poor human rights records. But here's another interesting point. Portfolio exclusions aren't just about ethics. For many investors, it's also about reducing risk. At the end of the day, portfolio exclusions are about making conscious choices. It's about looking at the broader impact of your investments, not just on your wallet, but on the world. Whether it's avoiding companies that pollute, exploit workers, or engage in shady business practices. Exclusions allow you to take a stand on the issues that matter to you. That's all for tuning in to today's episode. I hope this gave you a clearer picture of how ESG investing works and how portfolio exclusions fit into the bigger picture. If you enjoyed today's topic, don't forget to subscribe, leave a review, and share it with your friends. Thanks for listening, and I'll catch you in the next one.